What's up, everyone? Welcome back to the channel. Today, we're digging into something big. Both the stock market and the crypto market are under pressure, and there are real reasons behind it. We'll walk through what's happening today and why these markets are falling, the major contributing factors, and what this might mean going forward. We're going to be starting with stocks. So right now, major US indexes are showing signs of weakening. The broad-based index like the S&P 500 is down, the Dow Jones is also down, and the tech-heavy NASDAQ is being hit the hardest. Why? And that's because the tech and the AI-linked companies, which have been driving forces of recent gains, are seeing a pullback. For example, some of the big names that have led the rally are seeing losses, and their decline is dragging the broader market. That tells us that the overall market sentiment is shifting from let's go up or to maybe pause and let's reassess. And what's interesting, even though there have been positive earning reports, for instance, some tech companies still beat their estimates, like Nvidia, the market isn't celebrating like it used to. That's a warning sign. Often, when good news no longer moves markets higher, it means the upside may have already be largely priced in. So what's driving the stock market to fall back? So valuations are stretched. When markets run up fast, valuations, price relative to earnings or future growth, can be disconnected from fundamentals. In the tech and AI space, companies have seen huge jumps, but now investors are asking, can earnings and growth meet those expectations? When the answer becomes uncertain, stocks stop climbing and they often reverse. Interest rate and monetary policy. One of the biggest levers in the market is what the Federal Reserve, or the Fed, does with interest rates. For a long time, investors expected rate cuts, which are generally bullish for stocks, especially growth stocks. But now the data is sending mixed signals. Inflation is still persistent, jobs are mixed, and the Fed is signaling it may hold off on cuts. When rates stay higher for longer, growth slows, discount rates rise, which hurts valuations, and risk assets are tagged with more uncertainty. With risk-off sentiment and profit-taking, markets often move on expectations and emotions as much as fundamentals. When sentiment shifts from risk on to risk off, we see capital moving out of the growth and tech sector into safer assets like bonds or cash. Also, after a big run-up, many investors lock in their profits, and that creates downward pressure, especially in the leading sectors. Macroeconomic and geopolitical uncertainty. We are not operating in a vacuum. Some of the key uncertainties now include the labor market and whether the job growth is slowing, inflation data and whether it remains sticky, corporate earnings guidance being cautious, global tensions or trade issues reemerging. When uncertainty rises, markets behave more defensively. They don't always collapse, but they sometimes pause and they retreat. Another subtle factor is much of the recent gains in the market came from a small number of mega tech and AI stocks. Whether the leadership is narrow, the risk is higher, and if those leaders stumble, the impact on the broader market is amplified. Some analysts are now pointing out that the risk of an AI bubble or excessive concentration is real. Now let's shift to crypto. The crypto market right now is under major pressure. For example, Bitcoin has recently dropped below the $90,000 level, hitting a multi-month low. The total market capitalization of cryptocurrencies has fallen about 25% in the recent week, wiping out roughly $1.2 trillion in value. Major altcoins like Ethereum, XRP, and others are also seeing sharp drops, double-digit losses in the week. So in short, crypto is not just retreating, it's getting hit hard. And because crypto is a risk-on asset, it is amplifying the broader risk off move we're seeing in the markets. So there are several overlapping reasons why crypto is falling harder than stocks. So it's, for one, a higher risk profile. Crypto is often the first to be sold when fear creeps into the markets. When investors become more cautious, they dump the riskiest assets first, and crypto sits right at the top of their list. Second, interest rate and macro linkages. Just like stocks, crypto has become more sensitive to interest rate expectations and macro conditions. If the Fed is not cutting rates, risk assets look less attractive. A strong dollar and higher bond yields pull capital away from speculative assets. The dynamic has been evident in a recent sell-off. Liquidations and leverage. So crypto markets often involve a large amount of leverage or borrowed money. When prices start to fall, leverage traders get liquidated and they get forced to sell. That triggers more selling and it becomes a cascade. This kind of feedback loop magnifies crypto's losses. There's capital outflows and sentiment reversal. There are big outflows from the crypto investment products or ETFs funds. For example, spot Bitcoin ETFs are seeing money leave rather than flow into it, which is reducing buying support. Also, sentiment in crypto is shifting from everyone's piling in to let's take some profits and wait. When whales or large holders begin selling, smaller investors often follow. There's overlap with the tech and AI hype concentration. Crypto has in many ways ridden the wave of the tech and speculative mania. When the tech and AI bubble concerns surface, they often carry over into crypto. Many investors look at crypto as the next frontier of speculative assets, and also any signs of trouble in the tech and AI space gets reflected into crypto as well. And with crypto, there is regulatory and structural risk. While it's less immediate in the day-to-day, crypto also faces regulatory uncertainty, which increases risk premium. For instance, the classification of crypto assets, regulatory changes, and policy shifts still loom large as overhangs. Let's pull back and see the big picture on why stocks and crypto are falling and how they are interconnected. So the rate environment, both stocks and crypto respond negatively when interest rates cuts get delayed or reversed. Valuation risk, both classes benefited from low interest rates and high growth expectations, and when those expectations shift, both face a correction. Risk on and off switch. When fear enters, both get sold, especially parts of the market that had the biggest gains and the most risk. There's concentration and momentum. Many of the recent gains in both markets come from a narrow gap of names: megatech, AI stocks, and equities, major coins and tokens in crypto. That makes both vulnerable and momentum flips. Sentiment and psychology. Market moves are not just about fundamentals, but also about what investors expect and feel. The rise in fear, for example, with the fear and greed index, is a signal. And right now, we're in extreme fear. And there's economic and geopolitical uncertainty. When growth is uncertain, inflation is persistent, or trade and global tensions rise, all assets get hit. Because crypto is an extra risk, on top of these, it carries the same macro pressure plus structural issues, leverage, regulatory risk, and speculation. So the downside tends to be steeper and faster in crypto. What are things that we should be watching out for next? Interest rate signals. What is the Fed going to say next? Are rate cuts still expected? If not, risk assets remain under pressure. Economic data, such as jobs, inflation, consumer spending, corporate earnings guidance. If these surprise on the downside, risk may rise further. Sentiment gauges, for example, fear and greed index, the volatility index, ETF flows. These tell us when the market might be nearing a turning point. and specific sectors or asset triggers. For example, in crypto, major outflows, leverage liquidations, regulatory announcements. In stocks, it's going to be tech earnings misses, AI hype is fading, and big names reversing. That's a wrap for today. The markets are telling us the era of everything goes up is likely pausing, and we're entering into a phase of reevaluation, risk management, and greater caution. Stocks and crypto are moving because the backdrop is shifting, and understanding why matters just as much as what is moving. If you found this breakdown helpful, please like the video, subscribe, ring the bell so you don't miss my next update. Drop a comment and let me know, are you staying invested, taking profits, or watching from the sidelines? In which market do you want me to cover next? Any specific stocks or cryptos? Thanks for watching, and I'll see you in the next video.